my 44 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In today's video, I'm going to talk about the effects of what the actions that Fed did yesterday and how it's going to affect the banking system and the economy, and there's much more to cover. Thanks a lot. We'll see you right now. Well, welcome everyone to the Kendall Report. Sorry about yesterday. I thought I was going to make it back from my trip, and it didn't happen. It was way too late by the time I got back. So hopefully you all enjoyed the free Substack newsletter I put out last night. Remember, you can get that at kendallreport.com/newsletter. Yeah, it's interesting that somebody right away brings up the Japanese yen. My buddy Hugh Hendry absolutely is the best guy I've ever seen at calling tops and bottoms. He was screaming the sky is falling on the yen, and it reversed. So we should touch on that today. So let's a couple of things that we need to do just to clean up from what happened yesterday. And for me, it was a very big event. What I've been telling you folks on this channel for a while now, that you need to pay attention to the QT, otherwise a downsizing of the QT. Now they announced from 60 billion down to 20 billion. I'm not sure they ever were liquidating 60 to start with, but at least that was their stated goal. And I think that the scenario that we're seeing now is they are going to taper these sales. We saw an initial reaction with the interest rates, even though if we look at the action of the Fed, which I covered last night in the Substack, I think fairly well, as you get this hour, the first hour after the announcement of the Fed, you get this big spike up, then a reversal down, and then we see a rally back into today. And I'm going to set something up because I believe we've got some stability coming in, maybe going to set up a right shoulder that I've been talking about. We've probably seen the worst of the downside, so I'll cover that in a few minutes. And we're also in this tonight's video, we'll go through the WaveTech Database expectations for the weekend. This is a big run, I believe, and a test for the trends and how they're setting up. So let's talk about a couple of things that the Fed is doing, which I think is probably the most significant thing, is they are focused, it would appear, I think if you look on two things, labor markets and inflation. They're not really looking at the output, and I think there's a bifurcation going on from the standpoint of what's happening when you look at the economic output and specifically industrial production versus the employment numbers. And I still think the employment numbers are being cooked through the immigration situation we're seeing. And I'll talk about a couple of numbers here. Matter of fact, this is as good as time as any to discuss this. It's interesting, and I don't know how this happened. I saw somebody post this on X, I think it was last week, when I looked it up for myself. And today we got the claims numbers. Now they were 208, but this is interesting. The last 5 weeks, listen to these numbers: 208, 208, last week 212, 212, 222. I didn't go back further than that, but these numbers are all the same. And on the continuing claims, we've come down from 1.810 to 1.774. So the Fed's focused in on this unemployment number, and they're continue to use that as a dialogue, which to maintain the current policies that they've been running, which is keeping the front end of the yield curve higher. I'm not sure that's having any effect at all, and they should know this, but I'm not sure why they're keeping it at this level. But let's unpack a couple other things here. So Powell made a comment yesterday. It really caught me. It was almost like a slap in the face when he said it. He said, if productivity is lower than GDP, then that is inflationary. And we are seeing exactly that number. Productivity preliminary came out at 0.3. GDP is at 1.6, even though it's half of what it was in the fourth quarter. I'll try to make some sense out of this, so stay with me as I throw some of these numbers out here. But I think that's a significant situation to look at, is these productivity numbers. Now, if you read my annual report for 2024, and I'm still on that same theme that I talked about before, which is productivity will increase substantially, primarily through AI. And I know a lot of folks think AI isn't a big thing. When GPT-5 comes out, I believe this will be the game changer. And the productivity gains that I'm talking about are not till 2025 and beyond. So there was nothing expected this year, and we're going to meander, I think, forward for the moment as we're starting to see much more applications coming into the patterns here. So just make sure you note that, because that's an interesting number, and I think they are concerned, as I've been talking about, that CPI and PPI, that inflation is going to bounce back here. And I think it's kind of a echo bounce, which could move us from the 2.6, 2.7 levels that we're seeing, just rough generalized numbers, up to maybe 3.2, as high as 3.5 and higher. And this is likely to come into the fourth quarter as we come in to really the election time. I think these numbers could start to spike up, and mostly because I think of some of these productivity numbers that we're looking at. So let's. I'm just looking at my notes here. Yeah, this is the other metric that the Fed is looking at very closely. The JOLTS numbers continue to be we'll just call it 8.5 million jobs out there. And Powell keeps saying there's more jobs. They're keeping that metric out there. So the focus, my opinion, the focus of the Fed and what they're telling us is employment, and maybe they're looking at GDP a little bit, but they're not even concerned about that. As long as employment numbers stay in a very stable mode, they're going to continue on with these front end of the yield curve higher. We're going to go through the yield curve a bit tonight as well, because there's a couple things that I've been talking about in Substack. I'm not sure I've made it as clear on the YouTube channel, so we'll go through that when we go through the interest rates here shortly. But I've got a ton of notes here, so let me go through a couple other things that I think is where the bifurcation is coming in from the standpoint of the economy. So the labor side couldn't look better, right? Everything's solid, and folks are saying they picked my number. I've told you that the peak that I see on employment numbers is maybe up to 4.2. I do see an increase coming in, and it's interesting that the employment numbers are going to uptick, and I think inflation numbers are probably going to do the same thing. And so that's where I think where the Fed's narrative, it gets kind of broken here on what they're really doing, because I don't think both sides of the balance sheet, so to speak, are playing out exactly how it should. So I think there's going to be a bit of deviation, but I think mostly of what they're seeing is this potential echo bounce in the CPI and the PPI numbers coming. And of course, the PCE numbers are out there as well. So far, just to make my point, and then I'm going to come back and summarize this, is in 2024, we've seen a 1.8% decline in industrial production. And then GDP went from 3.4 fourth quarter to 1.6 in the most recent revision for Q1. So this is also interesting from that standpoint. And I've said a lot of things right now, and I'm trying to tie together some things that I've said in the past for those of you that are following the channel closely. But we go to retail sales now, and retail sales is right now, in December was one of the worst numbers. Think about that, at Christmas time, minus 0.8, January minus 0.6, and then we had an uptick in plus 0.8 in February. We don't have the April numbers yet. I'm not sure. I think they come out next week. Not positive of that. But the scenario that I'm trying to paint here is that the Fed is starting to see these numbers. And this is what I've been telling you, is that the metric to watch when they talk about is QT, that's going to have the most effect for the economy and the bang for the buck. And what I mean by that is if they stop selling as many securities, we should see that back into the yield curve stabilize. And like I said, when we go through the interest rates here just in a few minutes, I'll bring up a chart of the curve and show you exactly what the effects of what's already happened, because I am under the opinion, and I've said this before as well, both on the Substack as well as on the channel, is that I believe they've been quietly already pulling back the sales. And that's why we're seeing the yield curve starting to flatten out a lot, from a steepener starting to flatten, and it's actually steepening, and the back end is what it would be termed as appropriate. But the bottom line is I believe they've already been running these things, and I've been talking about this for a while. I kind of let the dialogue of that go away for just a little bit, but I'm kind of back on this after doing my research for today's videos. So I think where we're going to start to see most of the effects of what the Fed did yesterday, most people probably don't think they did much, but I think they did a lot. And I'm going to show you some of the patterns that are unfolding, already starting to be signaled, are suggesting maybe a little more positive look than what was outlook before. I'm not looking for any type of monster rally or anything in equities, but I'll show you what the stability looks like. And that was their goal, I think, is to put this out there. There was kind of the secondary comment. Then Powell said that they've decided to drop this from 60 to 20 billion in sales. So the effect of this ultimately will be more stability in the banking system. So I've got to go on one more little mini rant here as we're on this thread, is there is no banking crisis starting to unfold. Everybody from Alex Jones to who knows who are bringing in people telling you the banking system's going to collapse and all that stuff. And there's, I forget the number, over 5,500 individual banks. And folks, you need to know, I had a friend that used to be a bank examiner at a state level that went around, and without cursing, I can tell you most of these banks out there, a large percentage are POSs. They are worthless. They're run by idiots. They're not very well run. I've heard and seen a kind of an inside look on the kind of assets and the things they're doing on the books. These are very mismanaged type companies, and the good news is that the big guys will just come in and swallow them up, and there's probably, I wouldn't say we need to blow out 20%, but those banks that fall, there was only, I think, 2 years after the pandemic when rates were at zero, we didn't get any failures. But these banks fail all the time. And you see these guys come out, another bank fall. It's not a big deal. I don't see any systemic issues going on right now. Now, if we start to see a complete implosion of some of the metrics I just talked about, the labor market starts to roll, you start to see some of these other industrial production numbers really start to crater out. Maybe you get a more systemic issue there. But right now, the way that the interest rates are structured, the banks can do pretty good with how they're not giving away all the money, right? So they're still able to go out to their depositors and sell them CDs at a higher rate and still make some money, even though the real estate market is flattened out, but it's very consistent. I've talked to some people that I know pretty well, and they went from the world has ended with real estate to, well, maybe it's not that bad. And I think we're going to see a lot of these elements come into play. So I'm trying to get out of this loop I got myself into. But the bottom line is, the banking system is very solid. The Fed's balance sheet, and this was one last thing going back to the Fed. I told you when they started to cut back the QT, then you're going to understand where the balance sheet from the Fed's viewpoint, where it needs to be on an overall valuation or the amount that the balance sheet is. And I'm going to dig into that, probably talking about that in the next several days as we go forward. But I believe we're starting to stabilize the 7 trillion level. That was my original number going back a while back. So I went on for 15 minutes. Appreciate you listening for this, but there's just know that the end is not coming, not in the banking system. And I just have to propose one thing, and you folks can comment on this, is that, what's the advantage of if I were to come on here and tell you the banks are collapsed? Well, I guess the world we live in now is clickbait, to be first. If I said that and the banking collapse. Everybody forgot when I was on Meet Kevin last year, I told him there's no banking crisis, there was no recession coming, and none of this stuff was happening. And I can tell you the pre-discussion talk that we had before we went on camera was, him asking questions about all this stuff, and he's still promoting some kind of collapse, some kind of, clickbait is good when it's negative. And I've noticed when I put out, if I go market rolls over, collapse coming, I will get 3 times the views I would get if I said, hey, everything's okay, it's going to go up. It's just, it's been like that going back to 2020. And so we can continue to see that. But the markets are very stable. The Fed has plenty of money on the balance sheet to handle these little small banks that are falling, that have folded. It's just not an issue. And I know everybody wants to flash back to 2008 when everybody had the same trade on and it was a systemic issue. There's nothing systemic out there, in my opinion. Not at the moment. It doesn't look like they're even in the fringes that it's starting to happen. I think I finally got done. So let's talk about the rest of the video tonight that I want to cover. And the main thing that I want to get out of today is going through our database. As you folks know, the WaveTech Database is really integral in the analysis that I do and what my expectations going forward. So I'll build on that. I'll have some numbers out later when I get we see tonight's run. I don't see much coming out of this, but we're starting to get a little bit of attraction. I'll save some of this comment. We'll look at the database in a minute. So we'll do the database. We'll run through the normal aspects that we have. I'd love to go on a rant on Tesla, but I think I'll save that for next Tuesday because I think that everything will be good. And FF, thanks for putting that link out there. I'm trying to get Kevin to it was a year ago, actually. It was right before I went to Singapore last year. So it's right at this time where we did the review last year. So I'm going to try to get him engaged to do a follow-up. So anyway, appreciate that, Robert. You got 3 years on me. Nice hanging out with me. Okay, let's get into tonight's video. Let's go through the WaveTech database. All right, so we're looking at the overall database, and it's at 60.52% bullish. That's coming into some of the metrics that I expected last week. We did not see the selling that I thought we were going to see, and the configuration that we're seeing is likely to come back to around 58 minimum, but I think we're heading for 52 to 48% bullish on this database, and that's going to represent several thousand sell signals. Now, we got a pretty big tranche 2 weeks ago. Last week was not necessarily a dud. There just wasn't as much attrition on the database as I suspected. And if we look at the sector list, we now have 3 sectors that have fallen out of favor: consumer, cyclical, healthcare, and technology. And so we still have 9 of the 12 sectors, but I think we could start to lose a few more of these, and the sector rotations start to thin out a fair amount and give us a little more view into who's going to survive this. And what I mean by this is when we're looking at on a sector basis, I want to see who's going to be the survivor, where the rotation is. I suspect conglomerates getting close to getting out. There's a couple of these sectors that are long in the tooth, meaning they're somewhat extended. But we're finally getting to that point where we'll see some of these metrics start to roll off a bit and reset. And that's really going to be healthy if this market is going to hold in here. We're going to stay in some of the metrics. On Sunday night, I will go through a more detailed view of the longer term. I believe that'll happen on Sunday. This is a warning for you watching, is that I'm going on a mini vacation tomorrow. So when I'm out of town, things don't go well, although I think we've got a fairly good chance at some still upside up here. So, but overall, what I'm looking for in this database is some more selling coming in. This may be more of a material hit, even though the market stabilized roughly from last week, right? We're trading just below. There hasn't been any drastic movement like we had a couple weeks ago. But what happens with the database, it starts as markets start to go flat, then the momentum starts to fall out. They start to break their patterns, and then we start to see more and more selling coming in. So there's that. I'm going to switch this over to a daily view here real quick. And the daily view shows us we're at 17.95. I tell you this number both in Substack and here every time I cover this, but around 22%. If we can get above that level, then we have a reasonable shot at the markets getting stabilizing a little bit, maybe getting a bit more traction. It was kind of interesting, at least when I did my preliminary look at the metrics on the indicators and all of that, is I think you'll find it interesting. But this is my expectations for the database. Look for the intermediate to see more selling, dropping down deeper into maybe 58 to 52%. That would actually be several thousand sell signals. I think we'll see that kind of activity in tonight's run. If we don't, then that's telling us there's a lot more stability in some of these trends than I'm thinking. I think most of these trades that are on right now came in somewhere after the October lows of last year, so they're reasonably long in the tooth, but not extremely long. I've seen the database get much more dynamic than what we're seeing right now. So let's go ahead, let's go through the S&P and go through our normal cycle of events here. Okay, so as we look at this hourly graph here, we're seeing yet a couple. This was the big reversal that we got from this first green bar where my cursor is right now. That was after the announcement of Fed. This was the reversal into the close, and then we climb back in. And I've told you folks about, so if you have the indicators, and you have the market grid up here, when you see these bubbles, we always consolidate the bubble before it makes the next move. And the bubble just is an expanded volatility. And if you don't have the indicators, you can go to kendallreport.com/indicators. You can find out more how to get them. But the whole pattern here. We saw a bit of an expansion over here in the middle, this hourly graph again, and we get a little bit of a bubble, a little contraction, and we actually got a nice little uptrend setting up. And there's still a slight bias to the upside, but probably more sideways here. So let's go over to the daily. And the daily is interesting because we had that spike that we saw on the hourly chart actually went right to the RTX number. RTX was, I believe, 20. Let me just bring this up here. Yeah, so RTX yesterday was 51.20. The high was 51. Just trying to get to the right number. I'm on daily. Yes, that was high 51.13, and the number was 51.25. So we got just up to just about to RTX, and then we reversed. Today we printed up there again. We got to RXT was 51.20, and the high of this session was 51.18. So we printed in there. Let me see here. Yeah, 51.13. So we got right up into that upper band again. And you can see now we've turned the market grid up. I talked about this, I believe, in last night's Substack. We've gotten a little bit of a turn up in the market, but I still think that the key areas to watch here is going to be where these red dots are right here between 52.30 to 52.37. That's going to be your major resistance, and what I think we get is a possibility of running up and first testing the 40-day moving average, which is 51.85. If we can get through that, 51.20, 51.37 is going to be the upside on this, and I think that that probably caps this market off. We'll see how it trades. I see somebody mentioning Apple, and some of these stocks have already started to bottom and starting to get some decent formations from that standpoint. Yeah, and just a comment on Chris. Yeah. All they have to do is say something about AI, and they get a bump. It's not as good as Tesla and some of the rhetoric that they throw around, that Musk is throwing around. All they have to do is, we're going to build cheap cars, and the market rallies. And yeah, anyway, I'm not going to get going on that. So let's go ahead and let's go and let's take a look at the NASDAQ here. Just real quick before I move on, the market grid suggests for Friday that we're likely to see a range of around R2 is 51.35, puts us up in those numbers I just mentioned. And then on the 51.12 is first resistance, and then support around 50.70, 50.47. That's basically R1, R2, and then S1, S2 on the downside. All right, NASDAQ looks very interesting with the turn up here. The key level is going to be right at the 18,000 level. I think we're looking at 18,082 is going to be your resistance, which is that 40-day moving average. But if you notice, and the same thing on the S&P I just showed, you got a slight upward bias here, but nothing drastic. And we are getting on the NASDAQ that Friday is likely to be kind of a peak value. We should come back in and continue somewhat of a sideways level. I think as long as we stay up in the R1 level on the close tomorrow, which is right now, let me give that number to you. R1 is 17,662 or better, then you'll probably keep the market grid up and you could see at least another day or two on the upside, but it's going to get fairly edgy here depending on what type of activity we get on tomorrow. Cover the Russell tonight. I think it's interesting. Russell's trying to turn around, but similar resistance zones as far as the patterns go. We're looking at a 40-day moving average, and we also have a Fibonacci target at the same spot. So you're looking at 2050, and then we look at the fib targets here, and you got 2050 as fib target 1, so they're spot on. Moves above that would be up to 2101 from a Fibonacci viewpoint, and then another 2153. But all that is, even if we did rally, which would be a decent rally, we're just retesting, going back to the highs again. So this is a daily chart. We just continue to go sideways, and I'll put this up here. This really, to me, this is the most revealing chart. Is if we go back, this is all the way back the better part of a year. We're just continuing to go in a sideways range here, a slight upward bias, but as soon as we get a little higher than some of these patterns around 2120 plus, there seems to be plenty of sellers coming around. The only thing I can say that could change this, and we're going to go through the Treasuries here in a minute. The only thing that changes is if we do see that back end of the curve start to flatten out. That will be very substantial from the standpoint of what's going to happen with the Russell, because it's very interest rate sensitive, and most importantly, the back end of the curve means a lot more than the front. And so we'll talk a little bit more about that. Yeah, anytime Larry Summers talks, never listen. Close your ears, turn the channel. So let's go ahead and let's go move on to the Treasuries here. So this is the weekly chart. We're finally starting to see a bit of a pullback here. If we look at, it looks like we're getting to a peak of the yields. We came back into these Fibonacci targets that were live a number of weeks ago. Those numbers were suggesting a move up to 457, 478, which basically we came just shy of the 478, and then 490. Looks like to me that we're going to see a bit of a flattening here and a stabilization. We should stay above this 4.45, 4.50 should be the bottom end of the range. So let me just see if I can, I'm just trying to, I thought I had something preloaded up. Bear with me 1 second here. Second, I have to change something here. Okay. So this is what the yield curve looks like. And I put this in the Substack last night, but I want you to take a look at what's happened. And this is what I believe, this is why I believe the Fed's already started tapering, going back probably a month or more ago when I started talking about it. When the first time, maybe even the previous meeting, this illustrates there's a lot less pressure on the backside of the curve. You can even see now the blue line is the current curve that was as of yesterday. I didn't replot this, but the red line is what it looked like on 12/31. And it's an interesting contrast. You can see that the yields have moved up on the back end of the curve, but it's flattening out the exposure on the overall curve. And this is a scenario I've been talking about for a while, and I'll show you. I'll draw this in. Because I believe this range up here is where we end up getting this curve right here we start to see some flattening out of this pattern here. We're going to see the probably maybe ends up like here, and guess what that is? That's the 10 and the 30-year securities up above 5%. Now this scale that I have drawn up here is possible that we can move this line here maybe down here, and then everything starts to come in. I still think if we get anything to happen here from a yield curve standpoint, that this blue line probably moves closer down into here to 5.0. That would be basically 2 drops in interest rates. And the big talk is this is interesting, I think, is the talk that I heard. I think I overheard a Bloomberg review as they were talking that, well, is it okay for the Fed to lower the rate in September, right before an election? Isn't that going to be viewed as political? And whoever was the person being asked that question goes, oh no, I've talked to a lot of Fed members and they just do whatever they need to do on this thing. And I would tell you that if they do, it will be political. But the point is of what I'm showing you here on this yield curve, this is probably what's going to happen. We're going to see everything kind of normalize, almost flatline. And it's not appropriate to talk about longer term, like 2025 or 2026. But I think we start to rearrange a lot of stuff. I think the front end of the yield curve will come down substantially. The back end curve will stay up. And then I'll just draw on here is that ultimately we end up with something that looks like this from the standpoint where the bottom end is 4.2 and the back end is up and around 5 or so, or maybe they lower the scale. But we'll see the steepening yield curve versus what we've been seeing of the inverted yield curve. And I know that everybody said that the inverted yield curve would cause a recession. I don't think that's the case yet. I think they've managed to cook the books enough from the employment situation to other areas that they figured out how to make this thing look maybe a little better than it really is. And maybe you could use the analogy of putting lipstick on a pig. So, but this is, from my viewpoint, this is what we're likely to see start to unfold. And this is coming into Q3 and Q4 and beyond, that this is more likely how everything ends up. And I know that folks were giving me a lot of pushback a year ago when I was saying that there wouldn't be a recession because of the inversion, and the inversion is not always right. And you also have to look at why the inversion is happening. And in the previous situations with the yield curve, the inversion happened because of economic issues, not because we're seeing a readjustment and normalization of interest rates. My opinion, I get to have that, right? And that's why we saw the big inversion, because they pushed it up so fast and so high. But that wasn't done by markets seeing squeezing of liquidity and those type of things. It was done literally manually by the Fed to make it happen, just like they had it down at, at basically zero for 14 years. And so we're just seeing they've shifted that. Now we're going to adjust. These things take a while, especially with the economy as large as it is now. These shifts really take a lot more time, and it's too many people trying to trade, looking in the rearview mirror is the biggest problem. Okay, let's go ahead, and I'm going to go through the Dow and the Dow yen next. So let's go there. All right. Yeah. So as we look at the dollar, we can see there finally was a reversal. We traded up. I'm not sure when the last time I covered the dollar, but if we look at the fib targets, we can go back to the very 1st of April. It was projecting we'd get up to a couple Fibonacci targets. We only hit Fib 1. We're coming back in. Algos are suggesting, however, there's still a slight bias, so the Dow is likely to stabilize. The Dow is likely to stabilize right around this 104 level, and I don't see it collapsing a lot. It looks like more of a stability sideways. But here's the big talk of the town, and I kind of trolled my buddy Hugh Hendry, but let's do this. This is a huge move. We got this is a weekly chart. We got an outside reversal just 2 days ago. I'll show you the daily chart. Is when my buddy was screaming, the sky is falling, the end is over, the carry trade's over, everything's over, just, run for the hills. And this is a classic reversal. This is a really big event, and something that I talked about many weeks ago, that I thought we would get to around 157. If we got through 157, that would be a problem, and I would be screaming too. But it got to the target, and we got a huge rejection in a big way. And of course, the implications here are for potential Treasury sales and liquidation to support the currency, all of those things. And, all the talk of this is what it looks like when you do QE for 30 years and all of that, okay? I tried to show you the last time I covered the yen that this was actually a fairly normal, this is one of the first big corrections that the Japanese yen has had, and I could go there, maybe we'll do it another time, but there is. If you look back all the way to 1971, this is a blip on a screen, and it's up at the higher end of the range for the Dow yen. So the yen is definitely at a low here, but it's not the ultimate, right? It's really done quite well over the years, and in spite of all of the elements that it's been looked at. One of my claims to fame, you'll have to believe me, but basically when the yen was about to roll over and the Nikkei was just right at the top, I did a presentation in front of a very large group in San Francisco, and with a pretty esteemed panel of people, and I basically said that that the Japanese yen, and not only that, but the Nikkei were going to just plummet. It was like the end, and it was. 30 years later, we're still waiting for some new highs. But the point is that this is a big event that I'm seeing here. And the last time we had anything that looked like it would be on right here in the middle of the screen. I'll move that over, but it wasn't as big as reversal, but it was pretty substantial. And now with this pattern that we have here, this is really big. And we start to look at the from the standpoint of what the indicators are doing, what PPMs are doing. PPMs are suggesting that there's going to be a fair amount of support right at the line where we are right now, which is going to be, let me bring that up, right at 151.84. The highest that we got here in this pattern, by the way, we did print to 160.21. So it broke through that number. Let me bring this back up. You can see we had fib target 1 was 157, fib target 2, 161. We fell just short of fib target 2. Big rejection. All of a sudden, we're lower than we were last week, and most likely there's still a slight upward slope. So not out of the woods, but that spike is going to be big. And if we close lower next week, then we're likely to see multiple weeks lower from that standpoint. Okay, I'm just looking at a couple of comments here real quick. All right, so let's go from here. We'll go ahead and I'll go ahead and cover gold, even though I think it's in a consolidation pattern. Then we'll do Bitcoin. I'll come back on screen. So as I've been discussing on gold, I think that this coming week, this is a weekly graph on gold, that the market grid will turn back up. And ultimately, what I believe we will get here is a pattern like that unfolds, and we trade in this range here, and we stay above this 10-period moving average here, and we probably see the grid start to collapse in here, and market just trades sideways. And it will be probably somewhere between 2 and 4 weeks that we'll see the market break out of these ranges one way or the other. So we'll see what happens with that. But there's still an upward bias here. You can see the upward bias in all of these averages. So this is a substantial trend. That's why I believe we'll just consolidate, and we'll get some kind of market grid formation around here. And then somewhere over here or over here, we'll start to make some sort of move. But we're looking at going into October, November of this year before we're going to get anywhere into a situation where there's going to be a substantial move. All right, finally, Bitcoin. And Bitcoin has actually unfolded almost to the script that I've been writing for the last 7 weeks. And we're finally down at the lower end. We printed down to the fib target 3 level that I've been talking about. That level was at 56,500. We look at fib target 3. Low target was 56,735. Didn't seem very realistic, but as I've been saying for a while, I'm sorry if I'm getting annoying, but that halving event was so publicized, there was no way anybody was going to make any money on that. And even new futures in Hong Kong, new whatever, there's no demand here. There's monster distribution going on, I believe. And when I bring up the algos are literally on a cliff right now, saying this is not over, although I think for the moment, I put in last night's Substack. Let me just put something else out here. I want to show you a chart that I put in Substack, this one here, and this is where I think we're going to trade for the next several weeks. 55,000, 66,000 rough numbers, but we trade in this wedge. I've been telling you about this declining 10-period moving average. This is a weekly chart, and an advancing number from the standpoint of the 21 period. So the 21 period, we'll go back to the chart here. The 21 period moving average right now is 54,851. And this downward 10 is going to be dominant here, and you see the algos are all projecting actually for an extreme negative. You can see the shape of this 10-period moving average. This is the forecast. It looked like we were going to be able to stay up right at this, but we hit the peak, and now we've traded down. So I suspect you can probably trade in these ranges here right now. I'm going to draw in one last pattern just so you can see this, and hopefully I don't repeat myself too much on the Substack tonight. But let's just bring this up so you can see it. So the first pattern trading is going to be right here, is this wedge right here. So we trade inside of here. And then the secondary pattern is a bigger wedge, which is here. And ultimately, we probably see a break of this 21, and we set up a pattern here. So it's roughly, I'm just going to put this out here, potentially into August or something, where we consolidate this. Doesn't have to go as low as I'm pointing right now, but there definitely looks like there'll be continued downward pressure. And then at that stage, maybe we can figure out which way it's going. You can see the, let me clear up some of this stuff here. But you can see you've got this average, and you're getting, whenever you see moving averages in this kind of pattern where they're crisscrossing each other, that's usually a definite sign there's going to be a consolidation around that range. And I suspect when we get to that point, this is out into July and August, that we'll be able to see this configuration coming at us, and then decide whether or not markets go up. Also, just one last comment, too many predictions about 100K by year end. Anything's possible, certainly, but it doesn't look like there's going to be so much work that have to be done. This distribution that's happening right now is, I think, how's the best way to put this? Let me just clear this up, and I'll come back on screen here. Best way for me to characterize this is that all of the futures, the ETFs that just came in were going to be this big balloon, and everybody was going to run in and buy crypto, right? Well, it turns out that there was a frenzy of activity, but there was a lot of sellers out there just capping off this pattern. So I think from a best way from a fundamental standpoint, there is a lot of new players in, and they're not the hodlers that a lot of folks are, where they're just going to, white knuckle it on an ETF. If you bring in investment advisors and different types of investors, they have different way they react to price changes. And especially if you're just trading an ETF and you don't have the stigma of the taxation against Bitcoin and all the audits and everything that's happening, you're probably going to be a lot more flexible on how you trade this. So anyway, look at a couple look at some of your comments here. Yes, you guys are talking about rubles and other stuff. Okay. All right. Well, listen, folks, I apologize again for yesterday. I just couldn't get back in, and just be aware I'm out of town. So even though my review of the markets was positive, it's possible that that's not what's going to happen from that standpoint. Just because I'm out of town, I'm telling you, funny things happen. But I appreciate everybody. I'll see you on Sunday night. I am going to be out of town. I think I'll be back, but I'm going to go on X, and I'll let you know what my plans are. And Sunday or Monday, however it works out, will be I'll go through all the long-term charts. We'll go through S&P quarterly. All the big long-term stuff will be the focus. So thanks again for watching. I really appreciate it. And I will see you hopefully Sunday night. See you then. I don't hate Hugh. Hugh's actually a friend. Doesn't mean he's right. He knows it. I bet you haven't been to dinner, or Hugh hasn't been to your home. He has mine. I believe your comment was probably out of line. But I appreciate you being part of the channel. No problem. Have a good weekend. Discord so we can get rid of that crazy bot that keeps showing up. Watch for it.